You've heard me say how property investment is a game of finance. So today I'm going to share with you 10 things your banker won't tell you about finance. Plus, Ken Race is going to answer Vivian's question about, am I too old to invest? And even if you're not old, you're going to get some great lessons as Ken Race unpacks that question. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted our leading expert in wealth creation. That's the 5th time he's won a similar award in the last 7 years.
If you're interested in success through property investment, I've got 2 great things to chat with you about today. First of all, you've heard me talk about how I believe the game of residential investing is a game of finance with some houses thrown in the middle. So I want to talk to you about 10 things the banks aren't going to tell you that if you understand better, you're going to level the playing fields and know what questions to ask. The other topic I want to have a chat with you about is it ever too old to invest? This is where Vivian sent us in a question, Ken Race answers it, and whether you're young, whether you're old, you're going to get something out of this, even if you don't think you're too old to start investing, as we answer her question. So let's get on with the show. When I first started investing, people had a personal relationship with their bank manager. I remember I used to have to make an appointment, I had to put on a shirt and tie, and be impressive, but things have changed significantly over the last few decades. Nowadays, more and more of us use a finance strategist or a good mortgage broker. But the fact is today, when you go into a bank, you're on your own. You're on your own when it comes to your financial interests. And that's been shown recently in the Royal Banking Commission, which showed that banks really didn't have your interest at heart. So let's have a look at some of the things your bank won't tell you or your banker won't tell you. Of course, when you go in, they're going to be friendly, they're going to be eager, they're going to want to do business with you because that's their job. They want to make a profit. The bank wants to make money out of you. But this doesn't necessarily mean bankers aren't trustworthy or honest people. Sure, some broke the rules, as was shown in the Royal Banking Commission, but it's just that they work for large corporations and their role is to sell you products offered by their employers, which may or may not be in your best financial interest, may not be what necessarily suits you. So as I said, I want to share with you 10 things that they probably won't tell you. The first thing they won't tell you is that they can only offer you limited options. Obviously, they're not going to tell you about loan products that are offered by other banks or other institutions that may suit you more. The other thing is they won't tell you that they're salespeople. They're incentivized to sell. They want to give you a specific solution, including more credit cards and insurance, because the more products or services they get you to buy, the more money the bank makes. Now, sure, finance brokers also get paid by the banks for the services they offer, but they declare this income. Another thing your banker won't tell you is there are 3 doors into the bank. The front door is where most people go through, the retail door, where mum and dad clients go through. There's, of course, business branches available to larger accounts. The bankers here are more investment savvy. They're more business savvy. They're the ones you've got to get to see. And, of course, then there's the institutional branches. That's where the big boys go. You won't be able to get into those doors unless you have a smart finance strategist on your side. Now, here's another thing the banks don't tell you, but you've got to know, and that's that mortgage rates are negotiable. If you ask them, they can usually give you a better deal because banks would rather drop the interest rate a little than lose your business. They also won't tell you that an offset account is often better for you than a term deposit. Putting your spare cash into an offset account is effectively like not paying interest on your mortgage and therefore makes you money and doesn't give them the money in their term deposits that the bank wants. I think the banks are unlikely to tell you that fees are a big money maker for them. Why? Well, I guess that's reasonably obvious, isn't it? Nor are they going to tell you that some fees can be waived. Your bank won't tell you this, but sometimes certain fees can. So ask. I guess the worst thing they can say is no. Now, one of the things they won't tell you is that they're financial advisors. You see, I found a lot of people think bank employees are trained to help them with financial decisions. But that's not the case. Now, there are some banks that have divisions with financial planning arms, but again, the Royal Commission showed how they haven't been working in the client's best interest. Now, here's a big one. The bank won't tell you necessarily that it's the system that's going to decide your loan application. Many people think it's the bank manager or the loans officer who's going to decide. But the reality is it's all computer-based systems now that are going to assess your loan application. All of your information's fed in and your application is reduced to a number. Again, one of the reasons we always suggest you have a property investment savvy finance strategist on your side to stop you just being a number. Of course, the banks aren't going to tell you to shop around and get the best loans or financial products. Many people just go to their own bank to get another loan or financial products. It's easier, it's more convenient, it's a hassle to change banks. I know it is. Boy, there's a lot of paperwork involved in that. And they assume that they're just going to get the best deal because they've been loyal customers for a long time. Unfortunately, this isn't always the case. I guess these are some of the reasons, I'd be suggesting using a finance strategist to level the playing field. So what does all this mean for you? Look, clearly getting involved in property is a way to financial independence. That's what you're listening to this podcast for. That's what you go to my blog for. All I'm saying is get a good team of people around you. It's really, really too hard to do it on your own. And one group of consultants the team at Metropole have is built up over the years a team of a faculty of proficient finance strategists in each state to help our clients. So if you want to understand a bit more about how to get the banks to say yes to you rather than no, which is the default option at the moment, why not have a chat with the team at Metropole, 1300 Metropole, or go to metropole.com.au. And we're not finance brokers, we're not mortgage brokers, but we know the right people that you could speak to. In a moment, I'm going to have a chat with Ken Race, who's going to answer Vivian's question about when are you too old to invest. But don't worry if you're in your 20s, 30s, 40s, 50s, 60s. There's going to be something in it for you as we go through the fundamentals. Ken's going to give you some great insights. But before we get into that, I just thought I'd share with you that I'm here working from home today as I'm recording this podcast. I've actually got both my cats around me, Bentley and Harley, are rubbing up against me. They somehow or other seem to know when I'm standing here in front of the microphone, and I don't know what attracts them to it. And they're my company as I'm chatting with you. And I'm also taking the time to put together the fully updated curriculum for the 2018 Property Renovations and Development Workshop. I've been spending quite a lot of time on that because the world has changed. So while there's a lot of information about the property market and the world of property and to finance brokers, because finance is the key to getting involved in renovations and development, the faculty includes my business partner in Metropole Constructions, Greg Hankinson, who last year alone did 70 renovations and has done hundreds over the years. So we teach you my formula of buy, renovate, refinance, rent out, repeat, how to do it in a real-world reality way, not a TV show, reality TV show way. And with development, we give you all our internal checklists and lists. Actually, we do that for renovations as well with my property development manual. And Bryce Yardney, my son, who runs the development division and currently involved in over 54 developments currently, we will explain to you how to become a property developer. And it's not going along to Bunnings and getting a trade card or getting a discount. We don't teach you how to lay one brick upon the other. What we do is teach you how to run the business of property development. So why not join me in October, on October 20th and 21st, go to realestateworkshop.com.au, find out all about it, get an early bird special price, still the best price we've ever offered in all the years, and get my personal guarantee, and you'll have a chance to have a one-on-one implementation session with me. realestateworkshop.com.au. I recently received a question from Vivian that says, "Hi Michael, I'm in my early 50s, I've paid off my home, My husband and I are still working, but we're wondering how we're going to survive retirement. We don't have any investment properties. Is it too late? To answer that question, I've got with me today Ken Race, Director of Metropole Wealth Advisory. Welcome, Ken.
Oh, thank you. Welcome.
Now, unfortunately, this is a question we're asked all too often, isn't it?
It certainly is, from all age groups, funnily enough.
You're right. So people in their 30s wonder, am I too late? Because I read in the magazines people in their 20s started, people in their 40s think, I'm halfway through my work life, am I actually going to do things? In my 50s, they start worrying about retirement, and then in their 60s, they think, it's too late, I'm going to give up. But I think you've probably got an answer for most of those, knowing you, Ken.
Yeah, that's right. And can I say the best time to start is now, irrespective of which age category you're in.
Well, I disagree, Ken. The best time was 20 years ago, but the second best time is now.
That's it. Spot on. So I like that question. Is it, am I ever too old to invest? Because the real question is it ever too late to start making money? Because that's what it all boils down to. Investing is about making money. And one thing we find, the older we get, the less risk we normally want to take. So it's important to put your money in an asset that you feel as safe as possible in. The old adage of the higher the reward, the higher the risk. So what we've got to do is work and understand exactly what we're trying to achieve. So before investing, I ask all my clients to ask themselves 4 questions. And those 4 questions are, what is your tolerance to risk? What asset do you feel most comfortable with? The third question is the perennial one about debt. How comfortable are you with debt? Or what do you need to do to make you feel safe about taking on debt? And the fourth one, particularly as you're getting older, is how do I use my superannuation to actually leverage or kickstart that next investment stage?
Now, Ken, this is very interesting because when people get to 50s, 60s, or even 40s and haven't started to invest, deep down inside there probably is a concern with risk with them or a concern with debt. There's a reason they haven't done it. Now, some will say, I've just been too busy, life got in the way, I had to look after my kids, pay school fees, etc. But I think your questions are really very pertinent, and one has to be a little bit honest with oneself and ask the question, well, why haven't I done it up to now? So they're really good starting points, Ken. And I think the other thing it's probably worth mentioning at this point is there's 3 phases of investing, the accumulation phase. So people need time to accumulate assets. So investing doesn't give you cash flow straight away. Stage 1 is building your asset base. Stage 2 is consolidating it, where you slowly reduce your debt. And stage 3 is starting to live off your cash machine, Ken. So let's get back to how you would answer Vivian's question.
Yep. So the first thing I'd be saying is that given that you're in your 50s, you're both working, you and your partner, there's a reasonable chance that you've got a reasonable income. Your living expenses have maybe started to reduce, given maybe children have finished school or getting close to finishing school.
That's not always the case, is it, Ken?
It's not. But you're starting at that age to have, can I say, a little bit more discretion on where you spend your money. So the first big thing you've got to do is you've got to start sacrificing maybe current enjoyment for future benefits. And that's what I find a lot of clients aren't necessarily prepared to do. So that's the big sacrifice, that you've got to jump that hurdle.
That's a really good point, Ken. Somebody sitting under an oak tree today because somebody planted an acorn a long time ago, and it's that old story of wealth is the transfer of money from the impatient to the patient. So you've got to plan your future and now do whatever you have to do to get the future, to become the person you want to become.
That's spot on. The second thing I'd be bringing up is you've got to overlay capital growth and cash flow. So what you've got to do is you've got to start building the largest possible asset base. You've got to really put cash flow to the side at this point in time. Cash flow will come later. So you've got to start building the largest possible cash flow,
capital base.
Yeah, your asset base. And that, by its very nature, will include having to take on debt. And we use the term leverage. So you use a little bit of your money plus some borrowed funds to be able to buy a bigger asset base, a bigger valued asset, that with time will grow to then give you that choice of what will I do when that asset achieves your required dollar amount. So that now brings the first problem for some clients, and that is borrowing capacity. So unfortunately, although we say we shouldn't discriminate in our society, banks do tend to lend less the older you are. So we've got to bridge that hurdle of getting finance, which is why you need a very good finance strategist on your side.
You're right, Ken. Now, in the 50s, it shouldn't be a problem. As you get into the 60s, I guess banks aren't going to give you a 30-year interest-only loan, but banks are still happy to lend to people in their 50s and 60s. The terms may be different. You may have to pay it off a bit better, a bit quicker. But interestingly, I think one of the points that you were starting to make is that you can't afford to take as many risks as you get older either. So people who are younger, they've got time, they can make mistakes, not that they should, and time will cover it up. But for Vivian, one of my recommendations would really be, you haven't got another chance, you've got to get it right. So when you are dealing with this, get somebody smart like a finance strategist to help you, get a property strategist on your side. It's important to think that you're going to learn how to do all this on your own on the internet when there's people around who've got a different level of perspective and experience. So one of my hints to Vivian and anyone else listening would really be, don't try and do it on your own. So yes, you've got to take on a level of debt, Ken.
Yeah, and because as that first investment, as you're getting older in life, you really can't afford to make a mistake. And a mistake can be in one of two camps: a catastrophic mistake, so hopefully nobody makes that. But the hidden mistake, the one that nobody sees, is, did you buy an asset that didn't grow at the rate that you were really wanting? So a very small difference in growth rates over time compounds into a very large number. So you need to work with somebody to help you find that asset that will grow at the maximum rate, as opposed to just investing in anything. And I get a lot of clients who say, well, I bought a property. Yeah, but what did it grow at? And even a small difference, like a 2% difference in capital growth over 10 years, can be quite a substantial amount of money, let alone 20 or 30 years.
Definitely. So, what it allows you to do is get more rent, of course, Ken, because as the property goes up, the rent goes up in general proportionately. It also gives you the leverage to be able to borrow against that extra capital to buy the next property. So important when your timeframes are limited.
Correct. And that's what gives you the choice at the end, is the larger asset base.
I think that's a really good point, because at the moment Vivian's maybe wondering, or our listeners are wondering, well, how am I going to live off this at the end? And the answer is, we haven't even discussed that. And that's probably good for another topic, Ken. Is it going to be living off the rent? Is it going to be living off the equity? We don't know what the bank's requirements are going to be, what the serviceability requirements are going to be, how the banks are going to handle things. But as you keep saying, Ken, if you have a large asset base, you're going to have choices. If you don't have a large asset base, how are you going to live off it at the end? That won't really matter, because you won't have many choices.
Correct. And that's why leverage and debt is so important, because we can't save to that level.
Good point.
And it's very tax ineffective to save, because, depending on your tax rate, you might need to earn $2 to save $1.
Yeah.
Yet to invest, you only need $1 to invest $1.
Ken, that makes me think of something I'd like to mention to Vivian. is that when you retire and your husband retires, most of your assets are not going to be money you've saved. It's not going to be interest you've earned or rent you've got. If you think about it, your house is probably worth double what you paid for it when you bought it, Vivian. And similarly, your investment properties, most of what you're going to have then is going to be the capital growth, not the money you saved. So the capital growth is in a safe tax-free environment, isn't it, Ken?
Correct. So for Vivian, really, the first three questions that she and her partner will have to ask herself is, when do you want to retire? You know, have you got a 10-year horizon, a 15-year horizon? How much are you wanting at that point? And look, don't complicate it with, is it pre-tax or post-tax? You've got to put a line in the sand. You've got to have a target to aim for. And around that is going to be your current family situation. So once you decide those answers to those three questions, you now have to embark on, well, how do I reduce my risk? Because that's probably what has stopped most people investing at an earlier stage in life, is they were too scared. It was, how do I reduce my risk to make it comfortable to invest? So I've got a couple of suggestions for Vivian and the other listeners of really how to reduce your risk to then make you more comfortable to start investing. The first one, I think, is one of the most important, and that is to have a financial buffer. Have some money set aside in case things go pear-shaped. You lose your job, interest rates go up, you lose a shift. If you've got investment properties, you could be without a tenant for a short period of time. So have that set aside at the beginning. You don't necessarily have to use it, but that will make you feel more comfortable.
Yeah.
The second way to reduce your risk is to purchase in the most tax-effective way. You know, do I buy in one name? Do I buy in two? Particularly for property. I've been seeing a lot of clients lately who are buying properties in both partners' names. And while that sounds good and it might make the finance a little bit easier to get, what they're giving away is very large land tax benefits. Because when you buy as two, you only get one land tax threshold. So talk to a good property accountant, finance person to actually help you understand what is the best structure to buy in. Thirdly is look at risk mitigation insurances. So depending on your age, life insurance, TPD, trauma, don't forget income protection, because a lot of people, you know, could get hurt, they're off work for 6 months, their sick pay may only cover them for a couple of weeks. So have that money put aside. And if you've got investment properties, landlord insurance. Just don't buy an investment property without landlord insurance.
Ken, I think you're making a good point that people trivialise. They don't like thinking about insurance. But for Vivian and her partner, and in fact for most of us, one of our biggest assets is our income earning capacity. Vivian's got another 10 years of income earning capacity in her husband.
That's right.
Hundreds and hundreds of thousands, probably millions of dollars. And if you don't insure that, you're not insuring your biggest risk. And we're actually, your biggest asset, I should say. And the money involved isn't that much. On the other hand, it's something you hope you never use, but it's insurance just like you wouldn't drive your asset, your car around without insurance.
Correct.
So some good risk mitigation strategies there, Ken. Any other ideas for Vivian?
Look, I think while this is not to be taken as financial advice, please, I would be suggesting she has a good look at superannuation, because her and her husband are probably putting a substantial amount of money into super through their 9.5% super guarantee. And the banks are actually looking at that as income. So we can talk about super in another time, but that's a way a lot of our clients are leveraging their super balances into a larger asset that they'll let accumulate over time.
Now, to make it clear, while Ken's an accountant and a financial planner, you're not wearing either of those hats at the moment. We're not giving specific advice. But if you have got a lot of balance in your superannuation that is now in somebody else's hands, not yours, and you've not got control, and you'd like to maybe leverage it and buy a property in your super, why not have a chat with Ken and his team? Not somebody who's going to sell you property and set up a super fund to do that. Boy, there's been a lot of fuss about that recently in the Royal Commission, hasn't there, Ken?
There certainly has.
And a lot of people are getting wrong advice on that. But if you see Ken, go to metropole.com.au and click the Wealth Advisory tab and have a chat with Ken or his team to understand if it's appropriate for you, because it's definitely not for everybody. But that's a really good point, Ken, that's an untapped asset that many people have, that yes, it's yours, but you haven't got access to it till you're older, and you won't in your own self-managed super fund, but you'll have control of it sooner, won't you?
Correct. So you've got control and you've got an ability to influence the potential pot at the end of the day. And in retirement, the tax rate is zero. It's the nirvana for a tax accountant. How do I get a client's tax rate to zero? Well, there ain't too many options without getting into serious trouble other than super. So a lot of people are getting tax deductions while they're working, even though they're using super to grow that asset base that'll have the better tax rates in retirement.
Well, that's fantastic. So, Vivian, thank you so much for the question. And anyone else who'd like to get Ken's advice, either leave a question here at michaelyardneypodcast.com or go to metropole.com.au, click on the Wealth Advisory tab and see how Ken's team can help. And Ken, I know you specialise in helping professionals, successful investors and families grow, protect and pass on their wealth. Thank you so much for your time, Ken.
It's been a pleasure. Thank you.
Well, as we come to the end of another show, I'd like to read out a review I recently received on Stitcher. Now, I ask you each week to do two things for me. I'd love you to pass this show on to a friend who you think would need it, just like I'm trying to help you improve and learn more about property investment, success and money. Please pass the message on through Twitter, Facebook, a link, whatever, to one or two people each week. That passes the message on. That helps spread the word. That stops other people making mistakes. That would be great. I also ask for a review, and I usually mention iTunes, but Ben Campton just recently left one on Stitcher, and he said the following: fantastic content and delivery. This podcast is amazing and a must listen to anyone who wants to succeed in property, investing and money in general. Michael should be commended for the time and effort he puts into giving the information away for free. I'd say he's closer to a financial psychologist than simply a property guru. He's a living legend, and I can't rate this podcast high enough. He's not a flashy property salesman. He's incredibly intelligent, acumen and knowledge. Gee, thank you so much, Ben. Anyway, I appreciate the effort and time every person who goes to the trouble of sending me emails, leaving me a comment on Facebook, Twitter, LinkedIn, does. I appreciate the time you spend, and you know I always respond. So thank you very much, and if I read out your review, and I will read them all out, I'll even gift you a copy of one of my books, just as a way of saying thank you. And thank you for being with me again this week. I look forward to having a chat with you next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from today's show, we'd really appreciate it if you would leave a review, and we'll read it out on a future show, and Michael will gift you one of his books as a way of saying thank you. Just go to michaelyardneypodcast.com/review and let us know what you think. If you don't already subscribe, head over to iTunes or your favourite Android app. You'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 30 minutes.